news, which is the silver market. This is a 1 minute chart you're seeing here, but this has been one of the biggest swings in the silver market in a 24-hour period, probably ever. We both hit an all-time high and had the biggest overnight drop within the last, call it 18 hours. If you've been missing the silver market, are we good on YouTube? Are we good on YouTube here? Yep, we are live. Okay, perfect. Let me see if I can click that. That way I can see you guys' comments on here. Welcome, everybody. Happy to have you all on. So silver, what a move we have seen here. This has been the sleeper metal that will sleep no more, currently up more than 170% in 2025. And look at today's candle. This is a whopper. Opened up at new all-time highs, 80, quickly shot to $82 an ounce, and has fallen to $72 an ounce all overnight, all between 5 p.m. Sunday and 8 a.m. Monday. And this is what's known as a blow-off top. This is normal. This is what's going to happen when a global, what is this, $4 trillion metals market makes a parabolic move like this. It is nothing to fear. Long term, we're still pushing higher, but we got a lot of profit taking up here. And really, we've just reset to where we were on Friday morning. So we started around 72 bucks. If you missed the news, what happened essentially is, as usual, our favorite culprit, China has manipulated, I shouldn't say manipulated, but they've moved the market. And what's happened is there's kind of a bottleneck in the silver space in that the demand is greater than what's being produced. And China announced on Friday that it would be freezing exports of China. The government's basically going to come in and say, if you want to sell silver from China to another country, you're going to need a license from the Chinese government. And those are going to be pretty tough to come by. So turns out China smelled 60 to 70% of the global supply of silver. They're now going to hoard it all because this is a metal used in data servers. It is used in electric vehicles. It is used in pretty much every tech out there. Elon Musk obviously tweeted this, or tweeted a comment about it saying this is going to be a big problem. And so like anything, when demand is high and supply shrinks, the price shoots up. And we saw that in this just blow-off top move from 72 to 80 on Friday. It is now quickly reversing. But long-term, big uptrend here in silver. I mean, we are still a huge 10% above even the 20-day moving average, but been very volatile time. Now, we've been talking about buy gold, buy silver, buy metals all through 2025. Hopefully, you guys took our advice. If you did, you're up really big this year still. But there's plenty more to cover today because we are still, number one, still in the early stages of what I believe is a multi-year bull cycle in gold and silver. We have massive government spending, $2 trillion and counting deficit, meaning we're printing $2 trillion a year. You add that to the money supply, which is known as M2, and you can see the rise here. And when you continue to inflate the money supply, when you put more dollars into a system, more dollars chasing the same number of goods and services, the prices of those goods and services are going to go up. Don't listen to these clowns, these politicians claiming that, oh, it's corporate greed or Trump did this or Biden did. They all did it. They all do it. They all print. They all spend and borrow. And that is what is fueling the inflation. We are finally seeing silver and gold catch up to this as no longer wants U.S. bonds. Why would you buy a bond? It's the rate's getting cut, and they're inflating the dollar. They're deflating the dollar, devaluing the dollar. And so what has been the go-to safe haven for a century, U.S. bonds, people are no longer trust them. So saying, forget that. I want to hold gold. I want to hold silver. I'll buy palladium. Jesus, this is falling overnight. Look at the gap down in palladium. So just a big blow off top here. I think we're going to see it come down, probably base out for a couple of days, couple of weeks, and then continue this rise. So I'm still holding physical, not getting worried. But let's focus in on the stock market because there's a lot of opportunities out there. I want to see what we can find in the market, which areas are leading. Obviously, the mining and metal space has been super strong this month with the massive runs in gold and silver and all the other precious metals and commodity metals, lithium as well, steel as well, all of them ripping. But let's take a step back real quick if we could, and I want to walk through something. How many of you guys are on here for the first time? Type me if you're joining for the first live session, because I want to walk you through something that I believe is very, very important. And it is something known as the 4 stages of the stock cycle. And this is what it looks like. This is a weekly chart of Roku. I'm going to lay this out for you. But you're going to see the same thing show up in pretty much any growth stock. Okay, Google, Apple, Amazon, Nvidia, Netflix, you name it, they all go through this same process, and they do it over and over and over again throughout the life of that stock. And this is so crucial to understand, because if you have a stock in stage 3 or stage 4, you're swimming against the current. I don't care how good the company is, how good the earnings are. If it is in the markdown phase, it's gonna go down, period. And so our job as investors is to, as frequently as possible, get a hold of strong stocks in stage 2 and rise them higher. And look, 95% of the money you make in the stock market, I don't even care if it's buy and hold, your 401k, whatever, 95% of the profits you make in the market are going to be from stocks in stage 2. This is where we want to be focused. And it lays out, again, this has happened, it's been like this for 100 years, it's going to be like this for 100 more, because... And listen, I'm not saying the market's rigged. That's not the case. Don't listen to all those silver, tinfoil hat people. But it is an auction. And auctions are driven by the forces of supply and demand. Period. Hard stop. If there's more demand and supply, if more people are trying to buy something than sell something, the price is going to rise, and vice versa. So it stands to reason that people moving the most weight, buying or selling the most shares, are going to have the biggest impact in the market. And that's the big Wall Street shops. That's hedge funds, but it's also mutual funds, exchange-traded funds, it's pension funds and endowments and insurances, all these big multi-billion-dollar shops. So whatever they're buying is going to rise, and whatever they're selling is going to fall. It's literally just that simple. So when you come to this realization, you'll quickly grasp the idea that our job as investors is not to predict or to forecast. It is simply to interpret. We want to know what Wall Street is buying and what they're selling, because again, they're going to drive the price. We just want to hitch our wagon to their horse and ride along, have the wind at our back. And so this is how that plays out. Now, stage 1, and this is a weekly chart, by the way, so look at the scale on the bottom. Now, disclaimer, this was the COVID sell-off. Here where my mouse is, March 2020. So without that, it would have been more like a 1 to 2 year stage 1. That's why I've got this shortened here. But the same idea applies. In stage 1, it's called the accumulation phase, and this is when nothing is happening. It's like watching paint dry. Stocks just bouncing around in a range. It's usually well off the highs. And this is where Wall Street begins accumulating, all right? So if you're let's say you're a mutual fund, you're Fidelity, you're managing a $20 billion fund, and you're trying to own the right growth stocks. Well, you're going to do that based on some formulas. And they use what's essentially a giant Excel spreadsheet that says, okay, we believe this company has this much assets, they're making this much profit, they're going to grow by X rate for the next 5-10 years, we're going to discount that by where we think interest rates are going to be, blah, 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 and they come out with what they believe is a fair value. And based on all our assumptions, all the data, all of our high-dollar research, we believe Roku stock should be worth around $400 to $500 a share in a couple years. So it's trading at 100, they're going to start buying. And they're going to buy as much as they can, as cheaply as they can, trying to accumulate. But eventually the stock is going to break out and begin to run in what's known as the markup phase. And again, this is where all the money is made. Now, several things can push a stock into stage 2. It could be just a pure fundamental. Their sales, their profits are rising at a great rate. It could be at some hot shoe brand, like when OnClouds got big, or when Nike started booming, or when Chipotle Grill back in 2013 and 14 is opening 50, 100 restaurants a month. Maybe the stock is just in the right place at the right time. The last couple of years, anything attached to AI has been hot. In the 90s, anything attached to .com was hot. In the 2010s, anything attached to big tech or social media was hot. Whatever the reason, the stock is in demand. And so in stage 2, the stock is going to deliver a pretty sizable run pretty steadily. And I've got 2 moving averages on this chart. The red is just a simple 50-day moving average, and the white is a simple 200-day moving average. It's really all you need. And you'll notice that in stage 2, for the most part, the stock just really holds along that red 50-day moving average. There's no big dips, no big gyrations, no 30% downswings in a week. And the reason is, like I said, there's heavy demand. The big institutions who are buying, the Warren Buffetts out there, they don't just go buy 50 million shares. There's not that much liquidity. It takes them weeks, months to build those positions. So they're buying every day, every week consistently. And so anytime the stock drops 5 or 10 or 12%, they're using that as an advantage. They're taking advantage of that and buying more. So they have this consistent buying pressure. And retail, you and I do the same thing. Oh, I want NVIDIA. It's down 10%. I'm going to buy the dip, right? Whatever. And so it gets this steady rise. But all parties eventually come to an end. Whether it takes place in 6 months or a year and 6 months, it's going to come to an end. And that's stage 3 where you get the distribution. Now, the big Wall Street firms, they consistently and slowly buy, but they just dump it when they want out. That's why they say stocks take the stairs up and the elevator down. And you'll note stage 3 because you'll get the biggest drop you've seen since the beginning of the rise, and it will also cut down here below the 50-day moving average. And you look right here, after this steady rise for 6, 8 months, it falls 30% in a week. And that's a clear sign. The only people that can make a multi-billion-dollar company fall 30% in a week are big, heavy institutional investors, the ones dumping big. And that's your sign. They're getting out. Now, this is where most investors get in trouble. This is probably responsible for more losses than anything else, and the people I work with is they see stage 3 as a buying opportunity. We've been taught to buy the dip, and really we're working on a recency bias. Well, if you'd have bought NVIDIA when it dipped, or Google or Apple, yeah, okay, what about the other 6,000 that dipped and kept dipping, right? Stage 3 is not a buying opportunity. It's the beginning of the end. And as they're getting out, once all the big institutional investors, the Buffetts, the BlackRocks, all the big guys are out, that consistent and steady buying support is no longer there. And so retail investors, you and me, are you buying a stock every day for 8 weeks straight? No. You're going to buy once, you may buy twice, maybe you got a third bullet to fire, but that's it. Then you're out of money. And so with the institutions gone, the stock then enters stage 4, and this is just kind of a game of uncle, where it's like running stop losses and stop losses and stop losses. And this is where all the diamond hands fanboys come out, and I'm holding it. Fine, knock yourself out. Because typically in stage 4, a leading stock, a big mega cap leading name, is going to fall 50 to 80%. And if you go back and put it in logarithmic scale, look at charts of Apple and Google and Netflix and PayPal. They've all done it. They've all had these 50, 80% drops. Look at Bitcoin. It's done it too. And then the process repeats itself. The stock is now again cheap. It is now a value stock. And it's okay, now it's starting to look good, and they'll begin accumulating again, and the same process will play out when the company's earnings start coming back, or a new CEO comes in, or they've had a hot new product that reignites the company, whatever. So these are the 4 stages of the stock cycle. And this work is based on a guy named Richard Wyckoff, who published this work in the 1920s. We're now in the 2020s. It's worked for a century. Back then, you bought stock over a rotary telephone. Some 15-year-old runner took a scrap piece of paper down to the floor, and you got confirmation 4 days later. Today, we get confirmation in half a millisecond over our computer. The tech has changed. The game has not. So these are the 4 stages of the stock cycle. Any question on this? Explain ETFs? Sure thing, Rob. So knowing this, and knowing that our goal is to get stocks in stage 2, how do we know precisely where to buy? How can we shrink this from what is a big picture to get specific buy points? And to do that, you want to use a pattern like this. And let me find you some other examples. Let's see. Let me find one we've done recently here. Here was one we got in SMR. Let me see. It was OKLO. It's a great example. I'm trying to find a really clean one for you. 1 second. And I'll show you tons of stocks with this. I want to, if you're seeing this for the first time, I want you to see it on just a textbook example Okay, this is a pretty good one, RxSight. Let's look at this. So here's the pattern we're looking for. And this is going to get you into these stocks at the point where you've got the greatest chance of making a big, fast move. All right, and what you're going to see is this. And this is a daily chart, by the way. Now, I'm going to go back to bars. I know some of you guys prefer candles, but this to me is just so much cleaner and easier for everybody to see. All right. So you've got a stock that's in stage 2. It's up 20, 30, 50, 100+% off the lows of the year. Great, good. That's the one you want. Don't be like everyone else. I'm not going to buy that. It's at the highs. Folks, if a stock's going to run 2, 3, 400%, it's going to have to make a lot of new highs. Don't be scared of new highs. If you bought silver when it broke out to 50-year all-time highs, you're up 40, 50% in 2 months, okay? Don't be scared of stocks at highs. Those are the ones you want, the ones going up, right? So, again, you want to see some sign, initial sign of strength here. And when this is RxSight, again, I'll show you others, but look at this initial move here. Stock went up, 50% in 26 days, all right? That's a clear sign the big guys are buying. There's lots of demand in a stock that's up 50% in 4 weeks, okay? So instead of chasing it and riding through all this turmoil and saying, oh, I'm down, but it's coming back and all that stupid stuff, instead, we're going to find a way to buy right there. That's where we want in, right before the explosion higher. And so this is the process it'll go through. Now, again, a stock's up 50, 100, whatever percent, there's going to be some profit taking. There's going to be some people who want to sell, and that's going to drive the price down. But if the stock is, in fact, still in demand, if the big institutions are still buying, they're going to push it pretty quickly back higher. And remember, they're buying day after day. They're trying to buy as much stock as they can, as cheaply as they can. And so, again, not saying the market's rigged, but the big guys will use the powers they have to keep a stock low to accumulate. And this is things we see every day. When you see one of them go on CNBC talking about how they're worried about a certain sector, they think the stock's in trouble. No, they don't. They don't think that. They're trying to scare you out of it. When you see an analyst downgrade a stock, and those guys are paid by the company, by the same Wall Street shop. So they'll put a news article out about how the company's in trouble. They'll do something known as spoofing, where they send big sell orders into low liquidity periods that can drive the price down and run stop. They do all kinds of things to drive it down. But what you'll notice is each time they sell it off, it comes back. And each time it sells off, the dip is a little bit lower than the last. And what you get is this shallowing pattern where a stock kind of comes in, and I call tightening up, like this here. And what's happening in this process is the supply is being sucked out of this stock. Remember, there's not an infinite number of shares out there. There are millions, but there's not infinite numbers. And let's just make it simple. Let's say this company had 100 shares. We'll just dumb it down, right? 100 shares. Well, 20 or 30 of those are probably held by the founders and the top executives of this company. 50, 60 of them are just sitting in retirement accounts or long-term holds, or they're in ETFs or mutual funds. They're not like being sold. So the number out there available for sale, people actively trying to sell, may only be 10 out of those 100. And if these guys come in and they buy one or two here, and they buy a couple here, and they buy a couple here, and they're eating up the available supply. They're buying up all the available shares that anyone will sell at $12, $13, $14 until there's no more $14 stock for sale. Anyone they could scare out or shake out or bore out has sold the stock. So now if they want more, you got to pay up. No one else is going to sell for 14. You've exhausted it. There's a bunch of sellers here, and then a few less, and then a few less, and then a few less, and a few less. So now if you want more, will you take 15? Will you take 16? Will you sell it to me for 17 or 18 or 19? That's what allows these stocks to make these big runs really quickly. It's not necessarily the case that suddenly there's some huge demand uptick, although that can play a role. It's the fact that the same amount of demand is chasing a smaller pool of supply. If you got $100 chasing 100 widgets, they're going to sell for $1 a piece. But if I bought up 80 of those widgets and the same $100 are chasing 20 of them, they're going to go for a lot more, aren't they? And so this is the breakout pattern. This is going to be your bread and butter setup in a bull market when you have stocks in stage 2. You want to see it absorb, 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 and then your job is to buy right there the second it breaks through that supply. And again, this is just a really textbook clean one. But it's clear as day where the sellers are. Helen Keller can spot the selling here. They can't get above 14, can't get above 14, can't get above 14, 14, 14, right? Obviously, there's heavy selling at $14 a share. It's either a bunch of people, it could be one guy trying to sell 10 million shares at $14 a piece. But until those 10 million shares are purchased, the stock cannot go any higher. But once it does, once you've cleared that support, once all that you're through that supply, it is now free to run higher. And the other benefit of this approach is it's going to bring your risk way, way, way down. Because we always use what is known as a stop loss. And this is just it's a sell stop order. You do it on any broker. And sorry, I'm just going to take this watermark off so it's not as distracting. And it's an order to sell if and when a stock falls to a given price. So if you buy it at 14, you can put a sell stop order at 12, and it tells your broker, if this stock falls to $12, sell it instantly. Don't call me. Don't check on how things are going. Just dump it. That's where you want out. That's where you were wrong. And so anytime you buy a stock, the first question you should ask yourself is, where am I wrong? How much am I willing to lose on this? How low does it need to go for me to say, nope, I misread something, something has changed, I'm out? And most people don't take this dip. They don't have a stop loss, and so they get in. They have no plan for what to do when it goes wrong. They're down 15, 20, 30, 40%, and they're going, oh my gosh, do I sell here? Is it going to get worse? Is it going to come back? Can I get a break even? Don't be that guy. No, we're going to be. Let me go ahead and break it to you. You're going to be wrong plenty of times. The best traders in the world are wrong 40% of the time. The difference is how much money they make when they're right and how much they lose when they're wrong. I'm a total chicken. I don't take big losses. I have never, at least not in the last decade, taken a 30, 40% loss on a stock. I don't do it. I don't remember the last time I took a 15% loss on a stock. Not because I'm perfect, because I don't let it go against me. So look at this. When you have this pattern forming, it comes down and pulls all the way back up. It should not go back below here again, right? If what we're seeing is institutional accumulation, if what we're seeing here is the big guys buying it up, well, it shouldn't go back below the last place they bought. It continues, pushes back up. Now, it shouldn't go below here. These should continue to get shallower because that is where the buyer stepped in. And so as this forms and the tighter it gets, the less you need to risk when it finally breaks out. And so when it finally does break out and you buy it here, where's your stop loss? Where are you wrong? Well, I'm wrong at the last swing low. I know it shouldn't get below $13. So if I buy here at 14 and a half, my stop's at, $13, my risk is 11%. You can lose 11% and not be on the street with a cup in your hand. You lose 40 or 50, you're going to have a hell of a time getting back. And so if I'm risking 11% and I get into a stock that runs, in this case, 85, that's a pretty good risk-reward ratio. I'm not saying you would have sold the tippy top, but you get the idea. So it's really just a 1 + 2 = 3 process, okay? This is the S&P 500 index. Let's just look at the overall market. Would you say we're in a bull market, yes or no? obviously, right? The stock market just made new all-time highs on Friday. We're up 40, 50% since April. Yes, we're in a bull market. Okay, good. Let's find some leading stocks. Are they in stage 2? Are they trending higher? Are they up 30, 40 plus % off the lows? Good. Then just wait till they break out. And you can do this with any stock. I mean, let's just look at NVIDIA. Now, it's had a big run up, but it does this over and over again. Look at this. Look at how it formed in here. Do you see that? Now, this is January of last year. The stock was already up 350%. Everybody's chasing this same stock. But instead of getting in here and getting chopped to death, you just wait for it to tighten up, consolidate, absorb the supply, and give you a buy point. And it does that. This is a double. Clearly, it's in demand. Everyone's talking about it. It's coming in here. It's not tightening yet. Still getting deeper. I have no interest in a stock widening out and then tightening, right up here at the top. Where's the resistance? Here, 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 right? Clear as day. So when it breaks through on big volume through the highs, closes at the top of the candle for the day, up 6%, you buy it. Where's your stop loss? Right here at the swing low. That's all I'm going to risk. I've got the leading stock in the strongest bull market in a decade, in a once-in-a-generation technological boom. These guys pretty much have a monopoly on the chips. It's the best stock I can own, and I can get this thing with a risk of 6%. 6%. And look what it delivered. It doubled. Not in a year, not in a decade, in 2 months. Then what happened? Look at it. Where's the next buy point? Can you see it? It doubles again. Okay, let it tighten up and consolidate. Don't just chase the thing. Eventually, when a stock is doubling in 2 months, there's going to be some people that want to take profit. So let them do it. Let it come in and tighten up and shallow. Look at how beautiful this was. Right here at the end. 1, 2, 3, 4, 5, 6, 7, 8, just nice and tight. It gapped out, so it jumped on the gap. Boom, there's your buy point. You get it at the open, your stop loss is here, you're risking 10%, and it went up another, 30, 35. That eventually rolled over. Now, whoops. No, that's not what I need. Now, personally, I think NVIDIA is close to the end. You're getting some whippy action here. If you go like a weekly chart, this was the tariff situation where it came down and it's come back. But look at it now. It's whipping up and below the 50-day. It's getting kind of windy. It's not this just smooth. See how this nice stage 2 just pretty much held this 50-day moving average all the way. Got the big nasty sell-off, but came. This was the growth phase. This is a nice time. Now I think there's better opportunity. I'm not saying it's a bad company. I'm not saying it's going to fall immediately. It's not a clean early stage 2 stock. Can I suggest a buy stop for SLV? We're to buy on a dip. I mean, so we've got it down to 65. It's gone a little far, a little fast. I would just try to get like a 50% retracement. So from this move. So if I'm trying to buy it on a pullback, I'd try to get SLV at like 57-ish, 60, somewhere in there. Again, I'm playing the metals long term. This is one of those just macro theses that's just so obvious. We're not going to stop printing. We're not going to quit borrowing. The writing is on the wall. No one trusts the dollar. It's down 10% and counting this year. The bonds are not even rising on rate cuts, which is crazy. So now, by the way, guys, if you haven't already, there is a link below. If you go to tradewithross.com, we do these live sessions every single Monday. We have an additional one every Thursday. You'll get access to our industry strength indicator here to keep abreast of the leading areas of the market. You'll get my weekly newsletter, comes out every Friday, access to our support team, tons of stuff. It's $5 for the entire year. Okay, it's the best deal you're going to get in 2020. Hell, probably best deal you get in 2026. But go to the link if you see it, or just go to tradewithross.com. Get signed up. It's just $5 for a whole year. It's the best deal you're going to find because sometimes we may have to go back to doing these over Zoom only like we do our Thursday session, and we want to be sure you're on those, okay? So we understand the stage of the stock cycle. We understand the breakout pattern, how to buy those stocks. Well, how do we find the stocks to look for? How do we go from the 8,000 plus publicly traded companies and focus in on those 30, 40, 50 leading stocks, the NVIDIAs, the SMRs, the big movers who can make money? Well, the easiest way to do that is this. Focus on the sectors going up the most. And it all comes back to what we talked about earlier. What moves stock prices? It's not you and me. Terry, Alan, Rosalind, Philip, Claude, all of us here, if we all took all the money we have in our brokerage accounts, all put it in the same stock, we all tried to buy, say, Apple or NVIDIA all at once this morning, right at the open, it might go up 3 or 4 cents. That's a company that does 30, 40, 50 million dollars. I mean, let's look at it. What does it do? I'm sorry, billion. Apple trades around $60 billion worth a day. You and I aren't, maybe we got a billionaire in here, I don't know, but I don't think we do. So, again, what drives it is the big institutions. And the way they invest is typically thematically. You know, we don't realize it, but our size is our advantage. If you're trading a $20,000 or $100,000 or $500,000 account, you're liquid. You can move in and out of these stocks in 2 seconds. Buffett can't do that. BlackRock can't do that. When Buffett bought Apple, the most liquid stock on earth, it took him 2 months to build that position. So they have to invest somewhat thematically from a macro point of view, meaning they're not going, oh, I found this hot little biotech. No, they have to go, we're betting big on solar. We're betting big on metals. We're betting big on AI or whatever their big leading theme is. And so when they do that, they're going to buy a basket of stocks. They're going to buy all the companies leading up to that. So when AI was hot, they're buying obviously NVIDIA, which makes the GPUs. But they're also buying the companies that are building the data farms. They're buying the companies that are making the cables for those server racks. They're buying the energy companies that supply energy. Earlier this year, one of the big leading themes was nuclear energy. And when we looked at our sector performance tables, again, this is included with your $5 Trade with Ross membership. So if you haven't already, go to that link, get signed up there. But it's included with it. And all this does is it takes 40 leading subsector ETFs. And someone asked, an ETF stands for Exchange Traded Fund. It's the modern day equivalent of a mutual fund. So if you buy SPY, that's an index ETF. It owns all the stocks in the S&P 500. If you buy NLR, the nuclear ETF, it's going to own all the nuclear stocks. And so the goal is to give you exposure to a given area with one ticker, one simple trade. And so earlier this year, we looked at these. This is back in April and May. Nuclear was number one. Nuclear. It was very clear that's where they're going because they said, okay, AI's hot, but there's a bottleneck. They can't get enough power. The traditional transmission lines can't carry it. The grid can't handle it. They're sucking up 4% of the country's energy supply. On their way to 30%, they need their own power supply. And it's not going to be coal. They can't get enough wind. Energy in the areas they're building these, but nuclear makes sense. It's clean, it's renewable, it's got a small footprint. Despite what Spielberg would have you believe, it's actually pretty safe. And so the bet was that your Amazons and your Googles and your OpenAIs are going to start putting small modular nuclear reactors next to their data centers to power them. And so that's their big macro thing. We're going heavy on nuclear. And so they bought all the nuclear stocks. They bought SMR, which makes small modular reactors designed to power these AI data centers. And look what it did. Huge, 1,000+% move. We bought here in May. Look at this. And again, you see why we did it. hopefully. Same pattern. It was after a dip, but the same principle applies. Where it comes in, it's been falling, falling, falling. Let the supply get shaken out until it eventually tightens up, compresses, the supply is absorbed, and the stock is now free to go higher. And, we did that and got paid pretty quickly on this. But they bought SMR. They bought OKLO. Look at the move here. I mean, look what it did this year. Went from $20 to $200. They bought GE Vernova, which has gone from $350 to $700, right? And when they're doing this, when they're all buying all the stocks in a given area, that sector is going to rise faster than the rest of the market. So if you can see where the money is flowing, if you can identify the 3, 4, 5 small sectors that are climbing the market the faster, you know where the money's going. You know where the big shops are buying. So that's where you want to focus. Now, right now, it's a bit of a mixed bag. We're in sort of a rotational area. This will get much, much clearer in January, in February. But one of the themes I've been seeing all year is the mining and metals. Right now, it's number one, obviously, with this big run in silver. But remember, we're tracking 40 of these sectors. This is just the top 7. And yet it continues to be a leading area in the last 1 month, and 2 months, and 3 months, and 6 months. That's been a big theme. Central banks are buying tons of gold. Wall Street shops are buying gold. Silver's running because it's such there's a supply shortage, and it's such an demanding industrial input. And so once you have those areas, you just find the top 10 stocks in that group and put them on a watch list, and you wait for this pattern. Now, we did this on this live session back in April. And the leading areas that time, the ones showing up over and over and over, were mining and metals, quantum computing, nuclear, crypto, digital payments. And all we did was find the top stock. And this is the watch list I made in April. Okay, and I'm going to look at a year-to-date chart. Tell you what, let's just take this from April. And these are the stocks we found. Coinbase. You see where we bought? Leading area, bull market, coming out of a clean pattern, went from 215 to 450. Robinhood. We bought here at 50. It went to 150. MicroStrategy. That's not one I'd pick. It's been getting hammered with Bitcoin. Core Scientific. Again, this was put on the list in April. It was $7. And you go, it's going down now, Ross. Yeah, but I already tripled my money. I'm not still holding this thing. Look at Galaxy. Identified it in April. It was rising. We didn't get a buy point until July. But look at that. Clean, perfect tightening. Breaks out. Goes up 40%, 45% in a week. A week. Comes back, retests the same breakout area, giving you a second entry point. Goes up 90% in a month. Here was Cypher, same idea. We identified it in April, didn't get a buy point until August, September, but look how clean it was, and look at the move. Clean spark. We identified OKLO. We had a buy point down in here. And this is just rinse and repeat, folks. You're going to do the same thing over and over and over again. Get a good market, find the leading groups, find the top stocks, and find these low-risk buy points. This one here wasn't quite perfect, but you can see the same dynamics playing out. Big run up, comes in, starts to shallow, tighten, breaks out, goes on a run. Now, would I buy OKLO now? Not with your money. Clearly, the run is over. We're in stage 4. Put a freaking moving average on it. Sell some when it gets below the 20, sell the rest when it gets under the 50. You run a stop loss. You run a stop loss trailing the swing low. Here's how a stock should react. This is what it should do when it breaks out, okay? You don't need any indicators. This is what a stock should do when it breaks out. You don't need candles. You don't need anything fancy. When you get a good breakout, and let's put this in log scale so you can see it a little cleaner. It's going to come down. It's going to eventually tighten up and shallow. It breaks out. Okay, here's what a stock should do. It should stair-step its way higher. It should run, get a little, what Minervini calls a natural reaction pullback. There's going to be some selling in there. Break out and make a new high. Now, when it does, When it makes a new high, let's just trade. Let's pretend we're trading this live. Our initial stop loss was here. That's where we're going to sell it more wrong. It makes a big advance, natural reaction lower, breaks the new high. My stop loss is now here. I've de-risked the trade. I bought at 30, my stop loss at 40, 43, 45. Worst case scenario now, the stock falls over. I'm only going to make 50%. I'll be fine. Let's stay with it. Another natural reaction pullback, breaks this high. Once it gets into new high ground, guess where my stop loss goes? Up to the swing low. Does this again, pull back, breaks out, makes a new high. Where's my stop loss going? Up to the swing low. And we're going to continue to do this as it stair steps higher. My stop loss goes to here. And then where am I out? It stops me out. I'm making it stop me out. Take me. And what have you done? Well, you came in here with a risk of about 10 to 15%, and you made 263% in 6 months. That's a damn good trade. You did great. You say, well, how did I know to sell it at 175? You didn't. Don't let anybody lie to you and tell you they knew that was the top at 196. Give me a break. Nobody knows. Right? Now, there are signs we can look for. We can talk about that as far as, when you want to take profits on the way up. If you get a 3 ADR move, if you get the highest volume, if you get a close, stuff like that. But this is the process. And the 80-20 rule applies in trading more than anywhere else. 20% of your trades are going to give you 80% of your profits. So if you know half the crap I buy is not going to move the needle for me, if I'm going to be wrong 30, 40, 50% of the time even, my goal is to keep the losses small. I'm not going to get it right 100% of the time. When I'm wrong, fine. I'll take a 5 or an 8 or a 10 or a 12% loss. When I'm right, I make 20 or 30. I get one of these 230% movers. I had a good year. And we had dozens of them. We had SMR this year. Look at some of the nuclear stocks did here. We get into QBTS here at 9. It went to 45. And look at how clean this was. Do you see it? This one didn't tighten up as well as I'd like, but the same process, it's coming in, like, all right, it's tightening, it's getting ready to go. Nope, not ready, coming up. Well, then it breaks out. And look, 18% up day, highest volume in 3 months, breaking into new all-time highs. That's a buy. And it explodes higher. QBTS, look at this move we got. I mean, this was so clean. And I'm not trying to have a brag fest. I'm just showing you, like, you can do this, and there's plenty of opportunities to do so. It went from 4 to 9 in a week. Let it come in. Still widening. Oh, there it goes. Starts to tighten. Getting in tight here. Perfect time to buy. And look at that. You get in here. You had about a 12% risk, and you're up 170% in 40 days. Sell some. See if it's going to keep going. Makes a new high here. Perfect. I'm going to bring my stop loss up to that swing low. Oh, that tagged me out. Okay, I'm out at 18. Well, I bought at 8. I did fine. Look at IonQ. Breakout here, comes back. I thought it was going to break out again here, but it's kind of rolling over, so it hasn't triggered yet. Look at these metal stocks. Look at Coyer. Look at all these buy points here. Huge consolidation in here. Big run from 5 to 10. Take it a log scale. 5 to 10. Tighten up, breaks. Boom. There's your move. IAMGOLD. See this one? I mean, it's super clear. And these were areas. I'm not Monday morning quarterbacking. This is a buy in August. Mining and metal space has been leading for a year. Okay, let me see some questions here. I think I've missed some. What are the periods between the highs and lows in that tightening phase? Weeks or months? Yeah, it can be either on a really fast-moving stock, something that's up 100, 200% this year. It can be just 3 or 4 weeks. Sometimes it's 3 or 4 months. If you want to see a big one, you want to see why I was so bullish. Now, all right, this is gold. I held a special Saturday webinar, put in every newsletter I had to buy gold right there at $2,000 an ounce. It's now $4,300. Now, how? How did I know to get into gold there? Well, let's look at this. Let's go back in time, shall we? And I'll finish with this because this is super, super important. It's a great question you asked. What you want to see is multi-time frame alignment, ideally. Okay, so this is a daily chart leading into April of 2024. And while not 100% perfect, you can kind of see that same pattern here. You get the big run higher, which was here, followed by a pretty good shallowing. Kind of got a little loose in here, but tightened right back up and broke out, okay? Now, we stepped out on a weekly chart, and we can see this same pattern that formed over about a 5-year period. Again, rinse and repeat. Big run, 1,400 to 2,200. Okay, nope, not ready. See, it's still widening, and then it comes in and then just starts to tighten up, shallow. Again, breakout here on the weekly. And this time, which was crazy, we went out to a monthly chart. And you see the same thing here over the last 20 years. Big move up, followed by this massive multi-year shallowing cycle. So everything pointing to a breakout above $2,100 an ounce. That's what leads to big, strong moves. And people talking about silver. Oh, where'd this come from? This has been 40 years in the making. Put in logarithmic scale. Look at this. Look at this chart of silver. I mean, this is going back since the 1970. And again, it's not going to be to the penny over a 50-year period, but you see, this is the Hunt Brothers run. Just huge, shallow, tightening pattern in silver. So this breakout here through 50, people, oh no, it's going from 82 to 72. Folks, I'm looking for 200. Whoops. This is early stages in the silver move. And in all likelihood, we're going to see silver, I mean, just draw it out, probably up in here in the next few years. You're talking $200 to $300 an ounce. All right, so I got to hop off here really quickly. I have to get an epidural in my back. Yeah, lucky me, right? In about 15 minutes. But a couple of questions on this, the market industry strength indicator. If you haven't already, trade with Ross, ROSS.com. It's $5 for the year. Here's what you're going to do. When you get signed up or once you're a member, there's going to be a link to a page. And in fact, I'm going to put it, I'll put it up here in just a second. Let's see where I can find it. There it is. And it's going to take you to a page that looks like this. This is how you get the industry strength indicator. So all you got to do is just put in your email address and your TradingView username. If you go up here on TradingView, there's your username. And then once you have that, you're just going to go to indicators, and it's called the TA, Traders Agency, Industry Strength. And then you're going to add it to the chart. Now, what I've done, people say, mine doesn't look like yours. I added 2 of them. Okay, let me take mine off. I'll show you. So I added it once. Added it twice. And so on one of them, you can check the placement here. So I'm going to put the best 7. I'm going to do the 1 and the 2 month, and you can do 3, 6, 9, 12, whatever you want. Top right. I'm going to make it large. Hit OK. And that's going to be there. And then for the second one, again, top 7, but instead of 1 and 2 month, I'm going to go 3 and 6 month. I'm going to place it bottom right. Again, making it large. Hit OK. And now I've got them like that. Okay? Thoughts on PALL? Palladium, I'm going to let today trade out on Palladium. I got tapped out of this one the other day. If you guys took this, I did this in one of my Tuesday videos. If you haven't already, go to YouTube. I'm streaming this on the Traders Agency channel, but it's also, I've got my own channel, Ross Givens. I got a strike doing these live. I have no idea why, but yeah, we recommended this as a trade in here. And I did it live last week. I think I brought my stop loss to right here. It was just such a strong move in the palladium market. It was up like 25% in 2 weeks, which is crazy for a metal. So I got stopped out right here when it opened on Friday at 160. So, bought at 135, out at 160. I'm happy to make 20% in 2 weeks on palladium. On metals. It's not a company. That's a crazy quick move. But yeah, it's down today along with all the other metals. They're all gapping. It's just been we had a blow off top. Gold is gapping down just with the other metals. Silver gapping down on the news. Palladium gapping down. I'm guessing copper. Yep, copper gapping way down. Steel. What is the steel ETF? SLX, that's it. Nope, steel's still holding up. See the same pattern in steel? I'm telling you guys, this is rinse and repeat stuff. Somebody said beats a colonoscopy any day. Yeah, probably true. All right, guys, I'm sorry. We normally run these about an hour and a half. This is the only day I've got to cut short. But if you haven't already, go down below, tradewithross.com. Next week, actually on a Thursday session, we're going to dive into more specific stocks. And those are over Zoom. They are for members only. So if you're not a member, you're not going to get an alert to that. But again, it's just $5. No strings. It's literally $5. It's tradewithross.com. You get an annual membership to Black Ops. You get these every Monday, a live session every Thursday, access to our market strength indicator as well as our industry strength indicator. Get my weekly newsletter, which goes out every Friday. We put out, I think, a stock pick or so every month. You get access to tons of stuff in there. So go to that link, get signed up. I promise we'll go longer next Monday. But I hope this helps. If you have any questions, please let me know down below. I'll do my best to come back and answer those. You guys have a great Monday. We've got a shortened trading week. Yep, you get access to the trading indicator. Yep, you should see a link in there. To get it, I just showed it earlier. Just put that in, and we'll authorize you, and you can edit your trading view. All right.